All right, guys. So a few things on this episode of Finance Musings, episode 8, Netflix, Bill Ackman. The biggest things I want to talk about are let's look at what he did going into the stock in January and what he said about the company then and what he's saying now in April. And the question we have to ask ourselves is I feel like there's some Peter Lynch quote somewhere, and I did send a tweet and cold email Bill Ackman and reached out to the IR team. I was like, hey, Bill, would love to chat about Netflix. I was like, I will come to the office. I mean, we got the team, we got the mics, we got the cameras. And just, I feel like it'd be interesting to hear his thoughts as an investor, because what my goal is, I'm not going to do a deeper dive on Netflix. I'll save that for episode 9, because I'm going to go through their earnings call. I'm going to go through a few things one is the earnings call for, on April 19th. So one, it'll be them releasing their earnings. And just kind of the management press release. So one, we're going to go through that. Next, we're going to go through the earnings release. That's 2, and that's going to be from what was released on April 19th. But the third component is Netflix was at the Morgan Stanley TMT conference on March 8th, and there's a lot of interesting stuff in there. So to see the answers they provided on March 8th and contrasting that with what was said on April 18th or 19th, and then kind of what the earnings call and going through that transcript and seeing some of the questions that were asked. Because I forget the guy at JP Morgan, his name, but he has some really good questions. And it's interesting just to, let's look at how viewpoints changed from like January when Bill Ackman entered, where they were in March when they were at this TMT conference for Morgan Stanley, and then kind of what transpired in April. But for the purposes of this episode, the goal is just really 3 things. One is, what was the thesis for Netflix for Bill Ackman? What was the reason for leaving? And does that thesis hold true? And did he make a mistake by leaving? And I guess you could flip-flop the third point and the second point. So we're just going to dive right in here. So what we're looking at on the screen, and folks who are listening at home, if you are listening on Spotify or Apple Podcasts or SoundCloud or whatever, there should be a link to my YouTube or my website. Excuse me. And if you go to the YouTube, I have links of like where I'm pulling these from their websites, and it's just from Pershing Square's investor relations website. So before we get into this, I want to preface a few things when you think about a company, and I'll find where Peter Lynch gave this interview. He invested into some steel company, and the stock price like went down from like 50 to 15 to $3, and he just didn't know what was going on. And I want to find the right story because this is important. And he was like, the business has not changed. Like, has my view on the fundamentals of the business. So what that means is the end product, relationships with suppliers, cost management, meaning, what are we acquiring our materials for? What does our supply chain and logistics looks like? How variable are our costs? Are they growing? Are they contracting? Is our fixed cost remaining the same? Are we able to spread it out more evenly? Because we have a growing end base, growing customer base, stronger contracts, pricing power, whatever, right? The point is you have to ask yourself is, if we take all the noise out, fundamentally, how is it that the company produces a product or offers a service? And are they still able to do that on a consistent basis and make money? Meaning, hey, they're operating at a profit. So it means, hey, the cost to either sell this product or to provide the service and any other ancillary operating expenses, right? Whether that's overhead, human capital, whatever. Hey, are we at a net income level at a bare minimum? Are we just making money, right? Are we profitable? And then, you go in your cash flow from operations, look at cash flow from financing, look at EBITDA, EBIT, look at add backs, look at different free cash flow metrics, look at levered free cash flow to understand, hey, how much of the versus unlevered, depending on the industry, are their debt levels, where do their debt levels related to their comparable peers, etc. All those things, right? I know I want to keep all that in mind when we talk about Netflix, because a question I have to ask myself, and this is something I want to ask Bill Ackman, because like I really, really look up to Bill Ackman. Like, I sound like I'm crying right now. Bill, why'd you sell Netflix? I'm so sad. I believe in you so much, Bill. And well, I actually like genuinely sound like I'm about to cry. I'm not upset. No. The question to ask Bill is, we're going to read this letter from January 26th where he speaks glowingly about the business. And my question to Bill is like, hey, you got into Netflix because of X, Y, and Z, and we'll kind of speak to that. But have those fundamental drivers for the company changed, right? So we're going to look at this letter on January 26th, And then this is from their annual investor presentation on the 11th. Okay, and excuse me. And so we're going to go through those. And the goal is like, hey, by the end of this analysis and discussion, one, let's look at why Bill wanted to go in. Why did he pull out? Pause. But where the reasons he pulled out are the factors that he got in still in place because the business is still fundamentally strong. Now, I think what Bill Ackman would say is like, hey, Sajin, we have very concentrated positions. So we're really betting it all on 2 or 3 picks or, maybe 5 stocks at most. I think right now they have, Lowe's. God, what else are they in? Wait, let me just quickly see. I don't want to give anyone any false information. They have it right here. Hold on. They are in. Of course, I can't find it when I need to. Yeah, sorry. No, they're not. Yeah. Their new positions, Universal, Domino's, and then Netflix, and they didn't say where else they are. They might be in other things, but these were kind of like big concentrated positions, right? So the question, what he might say is like, hey, we need something that's going to be absolute home runs. And if we see even a single thing has changed, we got to get out of there. So with that being said, let's start into it. January 26th, Bill Ackman sends it out, letter to investors. Says, hey, beginning on Friday, over the last several days, we acquired more than 3.1 million shares of Netflix, making us a top 20 shareholder in the company. The opportunity to acquire Netflix at an attractive valuation emerged when investors reacted negatively to the recent quarter subscriber growth and management's short-term guidance. Netflix's substantial stock price decline was further exacerbated by market volatility. Let's stop right there. This could have been said, like if you took out January 26, 2022, and you put April 22nd, 2022, this would still hold true, right? You could say, hey, the opportunity to acquire Netflix at an attractive valuation emerged when investors reacted negatively to the recent quarter subscriber growth and management short-term guidance, which is, and no, that's stuff about their accounting, which is important too, but, right? No, this is January 19th letter. Where is, yeah, right? This is what Netflix put out on April 19th. So Bill Ackman's letter from January 26th, if you change the date, that what he said then could have held true for what happened in April, right? So let's keep that in mind, right? And then the same last point, still true. There's a bunch of market volatility, so things are continuing to be exacerbated, and it is what it is. Now this last paragraph is like you can't speak any more glowingly about a company than how Bill Ackman speaks about Netflix. I mean, he really sings their praises. Just listen to this, right? We have greatly admired Netflix both as consumers and as investors, but have never previously owned a stake in the company. Netflix is a prime beneficiary of the growth in streaming and the decline in linear TV driven by its superior customer experience. 1, vast and diverse amount of superb, constantly refreshed content. 2, global improvements in bandwidth. 3, and the proliferation and continuous improvement and convenience of devices on which one can watch, right? Have those benefits to Netflix changed? Are those things still not true today about the business and general market drivers for the company? Those are, right? So again, I have like hot water and tea, and I just got like honey on my, I have hot water and tea, honey got on my pinky. Anyway, so again, remember, if I change this date from January 26th to April 26th, you're like, oh, this all still makes sense and true, right? Now let's get to the second part of the letter. Netflix's business has highly favorable characteristics, which include its subscription-based, highly recurring revenues, which have enormous future growth potential, true best-in-class management team, economies of scale, superb quality and industry-leading content, which should continue to drive future growth, drive its moat, pricing power derived from the enormous value it delivers to customers compared with other alternatives, which is also true, substantial margin expansion with the opportunity for continued improvement due to economies of scale. I have my thoughts on margin expansion because if you go through their Ks, their accounting processes, how they're amortizing certain things, expenses, actual monies that they have to spend. I know I don't want to get deviated because I know I said I'm going to save the earnings and I'm going to save going through their SEC filings later. But guess what, guys? this operating margin, when you say margins are going to increase or stay steady, and they have been going year over year. Again, I haven't never really looked into Netflix in detail, and this is the first time that I'm doing so. So I'm going to have to pull up like their older Qs and older Ks and kind of really go into like, hey, what are they grouping in a cost of revenues? What's going into technology and development? What is like literally going into these buckets to understand like, hey, what are the trends? What has been, and I'm sure there are probably other investors who have done this, but something that I want to do to kind of better understand is like, where has spend, what is and this is going to have to be back of the envelope math, but essentially it's the math to be like, hey, what sort of X amount of spend resulted in X amount of shows, and of X amount of spend correlated in how many hit shows. So it's like for every dollar they spent, they were able to produce X amount of shows, or X amount of winning shows, or X amount of hours of TV watched, or X amount of like bingeable shows, or like X amount of shows streamed consistently, to get an idea of like, hey, is there a certain number of monies that need to be spent, in CapEx to produce content each year to put out a certain number of shows, right? Hey, we need to put out 100 new documentaries and film each year. We need to put out, what do we need to, what sort of capital outlays do we need to have to produce what type of content? And is there some sort of metric ratios? Are there some numbers there? Again, I'm sure there are, other hedge fund guys and other investors out there who have done that work, and, I'll find that as I do it and then I'll share it here. But that's stuff that I'm gonna have to do on my own, because when Bill Ackman writes substantial margin expansion, which to me means material, you're going to go from 10, 15, 20, I think like 30% is like, that's the 30% margins are great in any business, right? 30-40%, you're approaching like SaaS company territory. So I don't know how much more expansion they can get while they're trying to expand internationally and develop more local content, paying stars more for premium names to, premium talent to be in original programming. So margin expansion, I don't know how much more they can expand, right? If they're assuming at some 20% margin or something, right? So an improving free cash flow, which should allow for continued investments and growth. This is true. Now, if you held Netflix static for a second, in theory, their free cash flow would dramatically, when I say static, it means like, let's say they stop investing in new shows. They already have a library of content that, if someone were to value it, and this is extremely subjective, I'm sure it'd be worth at least $1 billion, if not like 10 billion, right? Maybe you just take as a proxy what MGM was sold for to Amazon, right? And you're like, all right, if MGM was bought for X billion and these are their titles, how many comparable titles does Netflix have and what does their library look like? Well, then we can say that, hey, Netflix's brand, just their library alone, is worth X amount. So if Netflix were just to be stopped producing content, and obviously let's say subscribers kind of just like dwindle to, people would just leave if they stop making new stuff. We don't know by how much, but the point of that analysis would to see, would Netflix be able to be, as a standalone company, what would their free cash flow profile look like, assuming no spend and just based on the strength of their current library? Now people are like, wait, why would we do that? Well, I would want to do that because when you say improving free cash flow profile, you're assuming that they're going to increase spend. There's so many things that you're assuming that are happening at once, right? And this is what I'd want to, and look, I don't think Bill Ackman would share this with me, and this is a lot of back of the envelope math, looking through earnings calls and transcripts and filings and kind of piecing shit together. And I mean, you read some of the footnotes, you can kind of get a sense, and even just kind of trying to do this math on your own. But what you're saying is like, you're saying multiple things are happening at once. One, we're driving customer expansion. Forget a saturated market of like they're what they call UCAN, so US, Canada. And, let's say, US growth is in single digits, but you're really relying on Latin, Europe, and other international territories, maybe at a double-digit clip, right? That expansion just doesn't happen because, like, oh, it's Netflix, right? It happens because they have made local content that have been global hits, Squid Games, Money Heist, etc., right? That costs money, right? Because once you have that hit first season, which is what you want, it's almost like, and I don't know if anyone's ever made this analogy, I feel like Netflix is almost like, it's kind of like the MLB, right? It's kind of like baseball, where you want to get your players in and do almost like also having an NFL quarterback. You want to draft a quarterback that does really well. You don't have to pay him that much his first few years. And then when they blow up, then you're going to have to pony up, right? But you've already achieved a bulk of success early on because you had pieces around him. So you look at something like Netflix where it's like, hey, if we can make hit shows in these local markets that we haven't penetrated yet, where a lot of places like India, Latin, a lot of European countries, where as broadband access to streaming capabilities expands, you're going to have the ability to get Netflix, right? But to stay a little bit more focused is that, hey, if we can produce something like a Squid Games or a Money Heist, right? That first season, we might be able to produce it at a fraction of the cost that we're going to have to produce season 2 for. But guess what? By season 1, as it is a hit, this would be a great analysis to see too, is like, let's look at subscriber growth based off of hit shows after season 1. Let's assume like an average subscriber price. Like, let's say after Squid Games, and I'm sure this is definitely out here, but let's say after Squid Games, they added like, 10 subs, like, a million, whatever, some number of X number of subscribers in South Korea or whatever, right? And, let's say they got those subscribers to come in at X amount of dollars. One, it's to think about, it's like, hey, that subscriber base that came in, one, probably covered production costs, will probably cover production costs for season 2. But then now you have to understand is that getting those people into the ropes off of the strength of that season 1 of this hit show is now going to get them kind of to permeate through the Netflix family, right? And kind of stay and get entrenched and kind of, hey, you're going to stay with Netflix for life, right? So that's why I made that analogy of like being a young baseball player where it's like, hey, your first year, hopefully you identify good rookies. So for Netflix, good content that's a hit the first season. So then when you have to re-up and start paying your talent and showrunners more for seasons 2, 3, 4, 5, whatever, guess what? You've already roped in 1 million new subscribers, right? That can now support the growth of that one show. But guess what? Those subscribers, obviously, they're going to support the growth of that favorite show or like the reason that they came to Netflix in the first place. But the ancillary cash flow is now going to go to fund new shows that might spawn another hit, right? So when you say improving free cash flow profile, it's like, yes, we're expecting growth at a top line of subscribers, growth in revenue, but that growth in revenue comes at an expense, which is to continually invest into new content, but also hoping that that brand library remains strong enough to keep your historical base there. So there will come a point in time, maybe in 5, maybe 10 years, where Netflix, it's like, all right, we're saturated. We have 1 billion subs, like we're tapped out, and then the argument that Bill Ackman makes, and I don't think it's in here, so I'm going to wait. Actually, because I was going to again say, at that point, then you look at other capital allocation strategies, share buybacks, giving dividends, because at that point, you're kind of like a utility, right? And that's what he argues here. So we'll take a pause there. I'd ask Bill, I'd be like, Bill, like, this hasn't changed, right? Fundamentally in the business, like, these points, these highly favorable characteristics that you have in the company have not changed. So, why is he letting short-term gyrations in the market impact him when his beliefs in the company's business model probably haven't changed as per what he said? So let's finish going through this. This is him talking about his hedges. I don't want to get into that. Okay. So this is what I really want to ask Bill Ackman. This is, fortunately, all of our portfolio companies are extremely high quality businesses that can withstand inflation as they have the ability to price their highly desirable products, services, and assets to preserve their profitability in an inflationary environment. We do not believe that the recent move in rates has had any meaningful impact on our company's intrinsic values. Let's just stop there for a second. You're saying that, hey, every business we go into is high quality, they can withstand inflation because they can price highly desirable products to preserve their profitability in an inflationary environment. That's exactly what Netflix is doing. That is exactly what they're exploring, right? So, and then this sentence, we don't believe rates has an impact on our company's intrinsic values. So that's where I'm so confused. And I know he'd argue like, yeah, well, it's not just rates, Saj. And I clearly say that it's because of, people leaving, the sharing passwords, how is this ad supported tier going to get added in? And that's what I'm excited to go through those earnings calls and earnings transcripts. But yeah, I am so confused. Like I'm like hurt. I'm like, fuck, Bill. Like, why would you do this? I mean, look, I'm not personally invested in Netflix at all. I'm just like a huge Ackman fan, and I always like defend him. In the group chats and friends when we're talking, I'm like the biggest. Bill Ackman stan. So everyone's been giving me shit like, yo, your boy took an L. And I'm like, first of all, he's not my boy. I've never met him. I don't know if Bill Ackman knows I exist as of today, as of April 24th, 2022, 6:57 p.m. But yeah, listen, I'm still a blind follower, so I'll leave that there. But getting back to this, as such, we believe that our portfolio companies trade at an even more material discount to their intrinsic values. So again, you're implying that Netflix is already at an implied discount. And I'll get into the valuation for Netflix and stuff when I go to the earnings. I'll go through like, hey, first of all, they're trading at pre-pandemic levels. I'm pretty sure at revenue multiples, enterprise value multiples, even forward-looking revenue multiples and even multiples that are 100% not trading at what their peaks were. And you could argue that they're materially devalued, right? So if you're going to say price declines that are market-driven, macro factors that aren't inherent to the business, why are you getting out of the stock, right? And again, we don't know what the stock will do tomorrow, blah, 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 but we believe our continues will compound their intrinsic value at higher rates of return for the long term. So here's the thing, Bill. Why are you leaving, right? So, and I'm going to kind of speed through this a little bit. And I know we don't want to look at price, but if we want to look at just absolute value, pre-pandemic, $386. January 20th, company issues lower than expected short-term guidance on margins and next quarter subscriber growth. Here's the thing. First of all, I'm so confused right now. I'm so confused. On January 20th, Netflix literally said, we're issuing lower than expected short-term guidance on margins and next quarter subscriber growth. So when they put this out on April 19th, and they literally say our revenue growth is slowed, blah, 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 and we'll go over this on the next episode, and we're saying, hey, streaming, where is going down, subs are going down. That's literally what they guided to. They literally delivered what they guided to. So as a public, like as an investor, if you see this, first of all, listen, if the company that I know that I want to get into, let's say I think Netflix is strong, they come out and like, hey guys, we're going to guide lower. We want you to lower expectations. We might lose subs. We're going to have, margin pressure. Subscriber growth is going to take a hit. The question I want to ask Bill Ackman is like, why did you go in January? Wouldn't it have been more prudent to be like, hey, I am a fan of the business and, whatever, we have our thesis, we have our, our value proposition, whatever. But here's the thing is that management literally came out and said, we're going to face margin pressure. We're going to have lower than expected subscriber growth next quarter. So just, hey, we are guiding our guide. That's the whole point of earnings guidance. It's to guide the market, to manage expectations. So if you know that, hey, we're already in a volatile market, and this was before Russia and Ukraine. So even if we forget about that, January 26th, and Bill Ackman knows this because if you read Bill Ackman, literally at the start of his investor letter, he's like, hey, we got into these hedges because it was our belief that, the Fed was going to have to act quickly to combat inflation. They're going to have to rise rates faster than they think. So this is what we're doing to manage our bets. So Bill Ackman kind of predicted that correctly. And that's why he's Bill Ackman, right? And he's a billionaire and he's making money. He's making profit. He's great track record. He knew that. He was like, hey, Fed doesn't understand what's going on. They're going to have to do X and it's going to result in Y. Doing X means, hey, we're going to have to raise rates faster and it's going to result in Y. And, in terms of an inflationary environment. So if you're Bill Ackman and you're sitting at your, with your committee and your investment team and it's January and we're getting ready to go all in on Netflix, but then, hey, they come out, they issue weak guidance, margin pressure. Why would we dive right in? Wouldn't it have been more prudent to have been like, all right, guys, we believe in the core business model. We believe what the company is going to be a multiplier in 3, 5, 7, 10 years, right? If you're looking, I feel like for, Bill, that is that time horizon, right? 3 to 10 years. We know it's going to be a multiple, maybe a 2, 3, 4, 5x, maybe 10x more, right? On your capital invested. Why not wait, right? Until they give guidance around this time in April and be like, hey, let's see what earnings actually are. Did earnings guide? And here's the thing, right? You believe in the business inherently, so you're not going to care about these short-term price movements. So let's say, they released earnings, and things weren't as bad as they said. well, yeah, sure, you're going to lose out on some gains, and because people are going to jump in and be like, oh, Netflix is fine, they're just pumping straight along. But it doesn't matter. You're not getting in based on the price of today or tomorrow. You're getting in for the price of 3 to 5 to 10 years down the line, right? So that's one thing. So either way, so let's say they would outperform expectations. Doesn't matter. Let's say on the second hand point where it's like they don't, right? They actually present earnings at what they guided to, which means like, hey, bad margins, slow subscriber growth, which is great for you because the market's going to overreact, especially in this environment, and things would have gone down anyway. So this is not, I'm not trying to make the case of like, some people be like, oh, Sajin, that's easy, right? Hindsight's 2020. Like everyone would be like, oh, hey, like I should have gone in when the price was lower and waited till the price fell a little bit. That's not at all what I'm saying. There are two fundamental issues I have. Is one, you're saying in all your writings before that, hey, we knew that the Fed was going to have to go in, raise rates. We know inflation's going to come. We know the market's going to overreact. You know that environment exists. That's one. Second thing is you are literally singing the praises of Netflix and saying, hey, Netflix is like the shit, right? So with those two things being true, and then you add in the third point of like, so first, again, a recap, we know rates are going to go up. Inflation pressures are going to happen. Great business. Third thing, management comes out, guides to lower expectations. So then wouldn't the reasonable thing in that case be like, all right, guys, like what's realistically going to happen is like, let's say the worst case, they guided to this, but the company outperforms. It doesn't matter. We're still going to get in. The other portion of that is like, hey, they guide to exactly what they actually do, right? Which means the company's going to take a hit, which wouldn't it have been prudent? All I'm saying is that it would have been prudent to wait to see what earnings actually would have been. And that's what I'm confused about. And again, I can understand there's like some like, hey, it's the benefit of hindsight, but I'd argue not. I feel like a guy as smart as Bill Ackman, why not just have a little bit more patience, knowing that inflation is going to continue to get worse, market's going to continue to overreact with these rate increases, and then third, we know based on what management said, we haven't. Let's say even if things come out flat, forget about beating guidance or performing worse than guidance. Let's just say things are static and everything's just flat. It's just flat. The market's still going to overreact, and you're going to see a decrease, right? So that's why I'm confused why they decided to go all in when they did versus kind of building smaller positions. And I think they became, top 20. So they could have easily kind of moved in a little bit slower. So again, that's my thing is that where was that patience? And I feel like I'm sure there's a reason, and there's a reason he's Bill Ackman and I'm here in my room. But I feel like he knew the stock price was going to decrease. And they went ahead all in January anyway versus, hey, let's wait till Q2 after earnings are released and let's see what happens then, right? Because and here's the thing, as an investor, you're not worried about the price because you're worried about not tomorrow's price. You're worried about the price 3, 5, 10 years from now, and you believe in the business. And this is why it's this slide, right? World's leading streaming subscription video on demand company, vast and diverse library, high quality content, high performance culture, led by a visionary team, subscription-based, highly recurring revenue, 26% annual streaming revenue growth, annual EBIT margin expansion of 360 bips, not too much leverage. I do want to look at some of their debt. I'm not saying this number is wrong, but I was looking at their filings and I was like, it's a little higher than that, but I don't know what they're adding back or how they're calculating you, but whatever. I'm sure their net debt leverage number is correct. People, you always want to do your own calculations. You always want to go into the filings and, God damn it. The fuck? Oh, you always want to go into the filings on your own, and you want to go to, and I think they have a breakout of their debt somewhere. Where the fuck is it? Other current, yeah. Okay, there we are. Right, so you want to go in. I don't care if it's God himself comes down and makes a memo and like, hey guys, EBITDA is trading at a 10x multiple. No, calculate the shit yourself. Go into the filings, see what type of debt they have, see when it's maturing, see what the issuance date is. You need to do this because just because someone says to go and buy a stock, you should not do it. You should literally go in. Okay, they have a credit facility. How much of it is tapped? What's the capacity? What are their covenants, right? And these are the things that like you need to do as an investor, and financials can look scary, but they're not. This is literally just saying, hey, we have this much debt as of this date. This is the interest on it. This is when it was issued. This is when it's maturing. It's not that scary. But please start getting in the habit of doing your own homework. And I'm saying that because I know someone might watch this, like, oh, Sajin, who do you think you are? You think Pershing Square calculated the wrong net debt number? No, they definitely didn't. The guys who work there and the women who work there are all smart. You just want to get in the habit of like, hey, I want to do my own analysis, right? I want to get into the filings. I want to read about the company. I want to read about the capital structure, so on and so forth. So anyway, so these things have not changed. So the core business thesis has not changed. Investment highlights, right? This is the point I made, right? In 10 years, they might hit 1 billion households. It might be saturated, but that growth from 200 to 1 billion, that's 800 million subscribers over the course of a decade, which is where he says, he's like, hey, we really think that Netflix can grow by 20-25% each and every single year, right? So industry leading content investments create powerful competitive moat. Again, what I said, scaling original and local language content, right, in these niche markets that they haven't penetrated, countries in Europe, countries in Latin, countries in Southeast Asia, right? Pricing power, it is there. They are passing that shit on, and that is literally what they said they are going to do when they came out in April. They're like, hey, we're trying to figure this out. So that's the question you have to ask, is that when you get these disappointing results, has the fundamental reason I got into the business changed? The answer is no, it hasn't, right? Still subscription based. They're still tapping into these markets. There's still a shit ton of people out there to get in terms of like international growth, right? Subscribers who are there. They're still investing in the content. They're still making local focused content that could have viral impact, that can grow and bring on subs, right? And again, that margin expansion can be there depending on, like I said, all it takes is another, Squid Games, and they're going to produce other hits, right? Inventing in a Tinder Swindler. You're going to have these, they have that machine down, right? They're going to keep doing it, right? And that's not hubris. It's just look at the money they're spending into original and scripted programming. And like I said, you might get 10 at bats, right? 9 of them might be like kind of they might just kind of be run of the mill, but that one's going to be that grand slam, right? That's going to bring in the money to then kind of feed the wheel again and kind of keep going. The one thing, and I'll stop after this, is actually, I'm not going to stop after this. So look, there are two things that when he put here that I don't know is completely right? So he's comparing the value prop of traditional pay TV and subscription video streaming. The one thing that I don't get is, and look, maybe this is just like, because when I look at a product or a service, I'm like, do I use this every day? How do I use the product? How does it impact my life? What products or things do I buy? What services do I consume? And what are the inputs that go into there? And like, is this company impact my life, right? And think about the investment in that way. So and let me know, like, if I'm wrong about this, but he's like nearly a third of viewing time is allocated to commercials. I can tell you right now, the last time I saw a commercial was the Super Bowl, because everything I watch is either TiVo'd or, DVR. So again, that's a little bit of my privilege speaking, because not everyone has DVR or has that. Or the second thing is, you watch everything on demand, right? So if you have Hulu, Peacock, HBO Max, you can log into your Fios account or your Optum account and watch your TV show online, like after it comes out. So you don't have to watch it with ads. That's the part, who watches TV on a TV anymore, right? And maybe that's just kind of my viewing preferences. This second point, restricted to viewing content airing at a particular time on a specific channel. Again, I can log on to my Fios account or my Optum account or whatever, and I can watch whatever show I want on demand without ads. And again, Hulu, Peacock, Discovery Plus, whatever, I can just go on there and watch the show that I want to watch. So again, I get these first 2 points, but maybe I'm the exception than the norm. Third point, 100% right. This part is also not true, because again, I remember last year when the Bucks were playing the Nets, Game 7, Gene, me, Buck, we were all out in Brooklyn, and we wanted to see what was going on in Game 7. So we just literally went on our phones, logged into our Fios, went to TNT, and we were watching Game 7 as we were like out going around in Brooklyn, right? So it's kind of like, it's not limited to television, because you can log into your Fios anywhere. And that's why like this fifth point then also becomes a thing, is that I'm not constrained by physical cable connection, because I can log on to my account through my phone. The 6th point as well, because I understand that you can't binge watch, but this is not just true to just cable TV. It's true to a lot of shows, right? On Amazon Prime, a lot of Netflix is one of the few people who just release everything at once, right? So it's not just, just cable TV. But the point being is that these are all good points. But point being is that, like, while these are all good, and I guess even this whole thing about like theatrical windows, I don't know if these points are good enough to be like, yeah, this makes Netflix like more attractive to the customer because there's more stickiness of like, oh, I can watch whatever I want when I want. But I feel like some of those are kind of weak points because I could do that for other services as well. So I say that to say is like, this is not like what you see on the screen here. This is not why I love Netflix, right? Why I love Netflix is what Bill highlights here, right? On here, what he highlights here again, and then what he highlights here, right? So some of this stuff I feel like is just a little ancillary. I don't necessarily see the benefit of this slide. So in conclusion, it's like, hey, the reasons why you got into Netflix haven't changed. You know that video streaming is taking market share. Netflix is already an incumbent with a strong brand library, with capital going in to make the brand library stronger to further penetrate the larger subscription video market. So what was such a decision that made you think that it was a lost leader? Maybe they don't think this is a lost leader. Maybe I'm being too critical, because when he says, when we sold it, in response to continued disappointing, but how can it be disappointing subscriber growth when they literally said we're going to issue lower guidance on January 20th. So how could it be just disappointing, right? And isn't this what you want? Isn't this what you want? Isn't that what we said? I mean, sorry, not we, I didn't. Isn't that what we said here? Where is it? Right here, Netflix investment highlights. Pricing power. So if they have pricing power, Netflix announced that it would modify its subscription-only model to be more aggressive in going after non-paying customers and incorporate advertising and approach that management estimates would take 1 to 2 years to implement. Forget the back half of this sentence. That's just noise, right? Let's look at this like middle part. Netflix announced that it would modify its subscription-only model to be more aggressive in going after non-paying customers. Okay, so pricing power, right? If you're going to take people from different households and be like, all right, guys, we got to separate logins and all that, aren't you saying pricing power translates to that? What they're exactly trying to do is going after folks who aren't paying, right? But this is what I'm saying that Bill Ackman would say is like, hey, we require a high degree of predictability. See, and this is why I say, when you say in light of recent events, you're saying you lost your confidence. How can you? I am confused. I'm so confused. I genuinely can't wait till Bill puts out like the next letter. Like he's 100% going to talk about this. Maybe he won't, right? I don't know. He might not expand on it or not, but I'll be watching to kind of get more thoughts, because I don't see where you're losing your confidence in their business. Is it their, I don't see where that is, right? And again, I'm going to end it with this. This is from their annual report. Just look at how glowingly they talk about Netflix, right? So I'm going to skip this first part where he's just like, hey, we do diligence, whatever. Despite its large scale, Netflix is still in the early stages of capitalizing on the decade-long secular growth in streaming video. This is where I said there's an addressable market of, let's say, 1 billion households, right? Netflix offers, bingeable content at a price point lower. But again, they have pricing power, so they need to increase it. Some losses would get offset by the higher price point, right? This was interesting right here that they did the math, and we could back into this. Is the Netflix subscription is one of the lowest cost forms of high value entertainment, with a cost per hour of engagement about 30 cents. So if you think about it, what they probably do is that it's $15 a month. How many hours does the average viewer watch? They probably back into that, and that gets you to 30 cents per hour that you watch. Netflix is well positioned as a dominant market leader, diverse library, content for everyone, kids, children's, adult. This is the volume, right? The velocity. that's very interesting because other people haven't caught up, and Netflix has that formula down. It releases 150 to 200 original content episodes per month, more than more volume than Prime, Hulu, Disney Plus, HBO Max, also Apple TV. I just forgot about them combined, right? So again, you're making the case that Netflix has been profitable while spending more on original content than their competitors. They're putting out more stuff with more velocity. They're already entrenched, right? And then the argument that he makes here, which is good, and I don't know, we'd have to see, is that what he's saying is that I think what he says here is true about Amazon and not Apple. What he's saying is that, hey, this is Netflix's bread and butter. They're going to keep spending money on this. But companies like Amazon and Apple TV, they're deploying cash flows from their other core businesses to fund video content, but they're not going to fund unlimited sums of cash to advance the video streaming business, which maybe for Apple TV is true, but I sure as shit can promise you Jeff Bezos will pump money into Amazon to continue to push Amazon Prime to the top. That's something I truly believe in, right? So again, with that being said, and you go to these last few points where, again, hey, cord cutting accelerates, price point for Netflix is easier, even a lower ad tier. Here's the other thing. Something that Disney Plus has, and this is one of the earnings call, they have an ad-supported lower tier. So when earnings came out in April and Netflix is like, yeah, we're going to look into lower ad-supported tier, all these different pricing, options or whatever, isn't that good? Isn't that what you want? Because now you're literally saying is like, we have a price point that is cheap for customers to experience and gain. So there might be a world in which we lose subs to this lower tier, but we gain subs, because for some people that discretionary income is not a lot of $15 a month, whatever the case is. And Netflix has some of the lowest churn rates, right? By a wide margin. Oh, it literally says it right there. So it's like all these core benefits of the business just don't change overnight just because they've reported earnings that they said they were going to report. And here's the other thing. So remember earlier we talked about operating margins. So in 2016, they were about 4%. As they've scaled, they've gone to 21% because you have to think about it. And again, I'd love to do this math, and I will when I do the deeper dive, is like the greater hits you spawn, the number of subs you bring in will more than compensate for that production. And now you can just spread out your costs more evenly, hence your margin increases. So subscriber count goes. I could see Netflix maybe topping out at maybe 30%, right? Because what you have to see is that even though they're going to continually pump new money into new content, at some point they're going to get to a point where like they've reached like saturated customer base, and they're going to have to continue putting money in to release new content. But at some point, the new monies that they put in, it's not like their capital deployment is just going to grow exponentially and not get capped, because once you deploy it into a series or whatever, it's going to stop and you kind of replace it. It's like one for one, right? It's not like they're going to try to produce like 1,000 shows at once. It's going to be like 10 at a time, and then those 10 get produced, those get paid for, then another 10, whatever, right? So at some point, yes, I feel like they will top out, maybe 30% margins. I don't know, but they're not there yet. And especially after what happened, there's only room, baby, growth, baby, runway, right? So, and here's the last part. We believe that the combination of continued subscriber growth and pricing power will allow the company to leverage its growing content spend. I'm sorry, I literally just said this, but these are in Bill's words, right? From the customer's perspective, Netflix's value proposition has become better each year as a growth in the volume of new high-quality content has comfortably exceeded price increases. 1. 2, we believe that the combination of continued subscriber growth and pricing power will allow the company to leverage its growing content spend over an even larger future subscriber base, which will drive substantial future margin expansion and provide a better value proposition to its subscribers each year. That's point 2, right? And now point 3, the opportunity to acquire Netflix at an attractive valuation emerges as investor concerns over short-term guidance exacerbated by recent market volatility. Volatility led to a substantial decline in company's price share. Those words could literally apply to April 19th. So, and here's the thing. They also said, did him and Reed Hastings have beef? Because I don't know why Bill got out. He literally wrote, although we expect some near-term variability in the company's quarterly growth and profitability, which Netflix guided to, we are confident in Netflix's long-term outlook. Over the next decade, We estimate the company can achieve double-digit annual revenue growth, significantly expand its operating profit margins, and grow its earnings per share to more than 20% a year. So, I don't know why. I really don't know why Bill Ackman got out. And so my biggest things, if we take the recap, is one, fundamentally, the reasons you got into the company, I don't think they've changed. When he says he lost his confidence to predict the company's future prospects, but I'd argue the reasons you got in January are the reasons someone would get in April. So one, the reasons you got in, to the core business, its operating, its operations to the business have not changed. That thesis, that investment thesis in Netflix has not changed. So why did you leave? Because what was true on January 26th is true on April 24th. The second thing is getting in January when you know that, hey, the company is guiding to lower expectations. It's a weird market environment, and when earnings come out, they're not going to hit guidance. It's probably going to be worse. That would be a better time to get into the company. And even if they do beat earnings, by how much more are they going to go, right? You're going to see a 5-10% increase. You're still going to get into the company because, again, we're not worried about the price tomorrow. We're worried about the price 3 to 5 years from now, right? And again, you are investing in the company for a set of reasons that have not changed. And regardless of the price went up, you're still going to invest into it because we're going to see 20% growth, double-digit growth for the next 3, 5, 10 years, right? So, but see, this is why I would love to ask Bill, and I definitely have to see if he went on interviews and talked about this, because one of our learnings from past mistakes is to act promptly when we discover new information about an investment that is inconsistent with our original thesis. That is why we did so here. I just don't see what is inconsistent with the original thesis, right? So again, hey, look, we could see maybe Q3 shit hits the fan even more. That was episode 8, guys. Episode 9, I'll go through the earnings call, things like that. And then in episode 9, I'll give my kind of decision if I'm going to be buying Netflix. Full disclosure, I don't own any shares at this time. And I won't be getting into it, or I won't. And if I do, I'll disclose it, obviously. But when I do the earnings call review, which will be more of a deeper dive, and obviously I'll obviously make up my decision by then if I want to get in or not, and go from there. But anyway, guys, that was episode 8. This is a great episode. I hope you guys enjoyed it. Like, subscribe. Yeah, peace.